This podcast is supported by the original organic bedding and bath brand, Koyuchi.
Koyuchi has spent 35 years pioneering quality organic textiles, long before the word organic became, trendy. But words matter to Koyuchi. Words like craftsmanship, longevity, and wellness. So what does the word wellness mean to Koyuchi? It means that all of our products are absolutely free from harsh chemicals and dangerous toxins that can seep into your skin. It means effortless style that looks as good as it feels with naturally breathable, pre-washed organic cotton. And what does all of that mean to you? Well, it means that you can sleep well in Koyuchi's crisp, cool, luxuriously soft sheets that are ethically made and made with you in mind. Live well, sleep well with Koyuchi. Get 15% off your first order when you visit Koyuchi.com. That's Koyuchi.com to get 15% off. Koyuchi.com.
Frequency Podcast Network. Stories that matter, podcasts that resonate.
Well, 2025 was a year of economic uncertainty to the max. The almost daily Trump trade announcements had everyone in quite the heightened state of anxiousness. The what's next factor was certainly at play. The ink on the new calendar year of 2026 is barely dry, and already we've got more goings-on with the U.S. move on Venezuela, talk from Trump about Greenland, and looking forward, the high-stakes trade talks for Canada, the U.S., and Mexico. Just a little bit difficult to forecast how things are going to transpire for investors, businesses, and households this year. Welcome to In This Economy. My name is Mike Eppel, and yes, it is tough to predict exactly how things are going to go, but we're going to try anyway. So joining me on the line is James McCann, a senior economist at Edward Jones. Hi there, James. Happy New Year.
Hey, Happy New Year. Thank you for having me.
Yeah, thanks for doing this. Appreciate it. When you were putting together your forecast for 2026, did you wake up on January 2nd to see the headlines about Venezuela now being in play? Because it's like, Trump couldn't even wait a couple of days into the new year before he had to throw some spanner in the works that would potentially upset any and all fearless forecasts.
No, it wasn't on my bingo card to see a U.S. operation in Venezuela, especially just a couple of days into the new year. So we've started with more news and volatility on the geopolitical front, and we'll see. We're hoping that this year is somewhat quieter than 2025, but that's not been an auspicious start.
I kind of thought that the initial reaction was telling, though, James, because immediately the market was saying, oh, this is going to be massive for U.S. energy producers. Canada's going to take a hit because Venezuela has heavy crude, and so do we, and the U.S. will just get more from Venezuela. And then we saw the initial market reaction on Monday. Everything kind of went the way those predictions kind of were. And then the next day it was like, oh, wait a second. It's like, this is really early. We don't know exactly what Trump meant by running Venezuela, how many billions of dollars the American companies have to put into the country to get anything going. Yeah, they've got big reserves, according to their own forecasts or levels of insight within Venezuela itself. But the fact is they're a pretty small player in the global energy market. So do we see this kind of time and time again? We think that something is going to be maybe bigger than it is, or it just takes that much longer for it to actually, for us to figure out what it all means.
Yeah, I mean, well, especially with this type of issue, I think traders, investors, they look at those huge reserves and they see the potential for long-term supply increases. And then I think maybe some of the reality, or at least the uncertainty, starts to kick in about the infrastructure investment required for that, the expertise required to extract it significantly, obviously the processing requirement on that heavy crude too, thinking about the ability to put that money to work over sort of multiple years, given some of the ambiguity already about what the political situation will be in Venezuela. So I think it is, that classic market reaction, maybe looking at the snapshot of the issue, and then perhaps reality dawns, or the complications behind that dawns, and markets have to take a little bit more of a conservative take on exactly what's likely. Certainly there's an upside for global oil markets in which this does unlock significant supply, and you do see more capacity I think, though, the path to get there is complicated and long. So you want to be careful with how you're pricing that at the moment.
Well, if nothing else, I mean, part of the discussion in 2025 was about Canada diversifying from the United States from a trade perspective. And what the Carney government announced with Alberta, the memorandum of understanding about building pipelines and getting more Canadian energy production. Does this, again, I think the initial response was, yes, see, we have to build our own domestic supply and find other markets as opposed to relying on the United States, even if the Venezuelan market supply doesn't come on stream immediately.
Yes, look, I understand this sense, and obviously Mark Carney is pushing this drumbeat very hard that it's important for Canada to diversify away from US trade and US economic activity. That's easier said than done, I think. You might be able to tell from my accent, I'm from the UK, and we've tried this a little bit. Obviously, we went through the Brexit experience, and part of that was saying we need to diversify our trade away from Europe and into faster growing emerging markets. Economic geography tends to be quite powerful. There is a strong association that you tend to trade with your nearest trade partners, and empirically that holds across a wide range of economies. So I think, we have to be a little bit careful that it's not really straightforward or at least quick to break some of those long established supply chains and economic ties. If we look at the hard trade data, I think 3/4 of Canadian exports do go south of the border. In some sectors, that proportion of trade is even larger. So, I think as a long-term strategy setting up that we want to diversify, I think that makes a lot of sense. I think in the near term, we need to be careful about, thinking that there will be something that happens overnight or that's sort of a near-term achievable policy agenda. I think for large parts, the US and Canadian economies will remain closely entwined. Certainly over the next number of years, it would be a long-term strategy to fully diversify.
I don't know if you've heard this news this morning about Prime Minister Mark Carney planning to go to China next week. First visit for a Canadian PM since before 2018. And of course, we've got, big trade issues with China, whether it's our blockade of Chinese EVs, what they've done to the Canadian canola market. So maybe there's a break to be had there if there can be some easing of the tensions. And for Western Canada, that would certainly be good if we can get the Canadian agribusiness going. I don't know if that would change your forecast for economic strength this year.
Well, I mean, this is part of the push, isn't it? And not just trying to work on relationships with China, just even within North America. So you are seeing Canada and Mexico try and push for a closer alignment, which I think is important. Obviously, sit within the CSUMA trade bloc. And so I think that is part of the strategy to try and improve these relationships. I think with the China story, there's an interesting sideline in that, President Trump has clearly been anxious and trying to push local trade partners away from trade with China. So there's been pressure put on the Mexican government to try and raise tariffs on Chinese imports. There's been pressure against Chinese investment, in particular in Mexico, because there's concerns that China or Chinese companies are trying to circumvent some of the trade tariffs that the US has levied on China by investing in local markets or nearby markets, which have more favorable trade relationships with the United States. So, I think trying to build those relationships is independently something that's positive. It's going to be interesting to see, the extent to which that perhaps exacerbates or creates additional tensions, obviously going into an important year of negotiations with the US and with Mexico over what the future of CUSMA looks like.
Interesting you say that. That was my first thought. What's Trump going to say about it? And it's like, oh, what are you talking to China for? Okay, so about the CUSMA or NAFTA renegotiations, look, that's going to be front and center here over the next 6 months ostensibly. But do you think we're actually going to see a three-way deal again, or is it just simpler to and just the dynamic with Washington? Is it better to just go bilateral and just deal with each country separately?
Yeah, I like that you called it NAFTA still. I mean, I prefer the naming. I didn't think it needed a rebrand necessarily. But to your question, obviously the President Trump has threatened first of all, walk away from the agreement altogether. Secondly, look to try and bilaterally negotiate. I think there's a lot of power in a North American trade agreement in itself. Especially in a world in which we're seeing evidence that globalization is increasingly fracturing. I think the economic diversity across, this continent is something that's potentially quite powerful, and having a strong trade agreement that covers not just the US and Canada, the US and Mexico, but covers all three parties, I think provides significant additional economic diversification benefits and trade diversification benefits. So I think there's a strong case for that agreement to remain across three parties, and I think it's most likely it will remain across three parties. I think there's definitely going to be grandstanding in the next 6 months. It wouldn't surprise me to see the US President Trump threaten to leave again. If we cast our mind back to 2019, 2020, of course, there were threats during the renegotiation of NAFTA to do the same. This seems to be a common part of the trade policy playbook. But I do think that given the very closely integrated supply chains across North America, it makes a huge amount of economic sense to keep that trade agreement in place. Albeit, definitely we'll see tensions around certain segments and parts of that where, each side will be pushing for modernizations or changes based on their own personal interests.
Are all forecasts for this year, I think you're calling for a 2% GDP output by the end of 2026. Is that completely predicated on whether or not there's a trade deal or not?
I think so. I think if you were to imagine that, the negotiations were to fall apart and we weren't just seeing grandstanding, we were seeing serious signals around exit, and that was followed through upon, the macro outlook would look radically different in Canada and Mexico and the US. I would sort of caution. So, I think that consensus is firmly predicated on, broadly speaking, this agreement remaining, largely intact. Whether there are changes around, let's say, the dairy sector or digital services, or on the Canadian standpoint around those tariffs on sensitive sectors like steel and aluminium, for instance, those are perhaps smaller. Those are perhaps smaller economic or at least macroeconomic questions. But for large intents and purposes, I'd say, the consensus around the economist community and then the investment community too is expecting the deal to hold.
Let's change the focus a little bit to the Canadian households. 2025, if you had money in the market, you were probably doing pretty well. Canadian stocks were certainly outperformers. And again, it was really focused though on specific sectors. What's your best guess kind of for this year for themes for Canadian investors? Or should we, again, looking at, diversification's never a bad thing, but again, had you had your money just here at home last year, you did pretty well.
You did. Helped by the materials sector. Obviously, what's going on in gold markets, very, very powerful. For Canadian equities, or at least the TSX index was underpinned to some extent by what happened in gold markets. And we do get clients who are asking us increasingly around gold, partly given the strength of its rally, but also partly given some of these concerns they have over, let's say, the future of globalization or the future of the dollar amidst rising debt, central bank diversification for their reserves. So, I think that's an interesting wrinkle in the TSX, that it does have that gold exposure, making it maybe attractive for investors who want some exposure into that gold story. But if we look into 2026, I do think the returns will be driven more broadly. If we look across the earnings profile for a range of sectors, then we're expecting to see double-digit earnings in many of those sectors. So I'm optimistic that the outlook for Canadian equities remains relatively positive. But your point around diversification, I think, is a really good one. And I think we would be advising clients at the moment to say, take a look at equities from a very holistic perspective. I think it's great to have some exposure to the US AI story, but we don't want all our eggs in that basket. We quite like mid-cap stocks because maybe we think they focus in more on the slightly lower interest rate story, particularly in the US, and maybe some of that economic improvement story that we're seeing. from a foreign perspective, for an international perspective, we do think there's an improvement more broadly in international growth and international equity earnings as well, corporate earnings as well. So, that's attractive too. Of course, part of this will be driven by what happens from a currency perspective as well. And last year was a year where the US dollar was depreciating. I don't think you'll get another 10% decline in the US dollar. So that might, perhaps limit that benefit or that tailwind you got for domestic stocks in Canada versus international stocks. But certainly I don't think it's going to be a particularly difficult backdrop in terms of what's happening in currencies either. So I think there's a few reasons to be positive on equities. We do think diversification, though, pays at the moment.
Well, one thing we haven't actually seen since April last year is any type of significant pullback for stocks. I mean, it has certainly been a momentum play. Is some of the continued uptrend, is this the year that AI kind of has to start paying for itself? I mean, they're spending money to develop it to the tens of billions, hundreds of billions of dollars, but has the return on investment been there yet?
Well, certainly the earnings growth has been very, very strong, but I think there is some fear that part of this is driven by a circularity around this really extraordinary investment boom. And your question is absolutely right. The critical judgment that investors have to make now is, will there be a major payoff from that investment? For the time being, we still think that AI stocks can deliver decent returns. I think that investment boom probably has longer to run. We're mindful that there's probably not much room for valuation expansion. So we do need to continue to see that improvement in bottom lines and maybe some early evidence that investment is paying off. It might be the case that you see more differentiation within the sectors. So investors looking to pick winners and losers around this leg of technology. But really, I think what's going to be interesting this year is we'll see a broadening in performance and a narrowing in the gap between mega cap technology stocks and the rest. So that improvement in broader equities earnings, I think that is something that means that some of those performance gaps will become less apparent. And so that's one of the reasons, again, why we think we want to have exposure to that long-term structural story around AI investments. I think we're cautiously optimistic that technology will generate important breakthroughs in productivity and help pay for some of those investments. But certainly we don't want to, especially given the strength of the run, have all our eggs in that basket. And so I think that adds to my case earlier for that diversified approach.
Before I let you go, James, we have to have the forecast for the Bank of Canada. What do you think? Do they cut rates at all this year? The talk had been late last year that by the end of 2026, they might be talking about raising interest rates. Is that in the realm of possibility? Or again, does that just come back to, if there's no trade deal, all bets are off?
Yeah, our view is that they'll sit on their hands this year. I think they feel the policy is in a good place. Their judgment is that at present, you're applying maybe a very moderate stimulus to the economy. I think that combines with obviously the fiscal changes that we've seen over recent months with a more supportive fiscal backdrop. I think it combines too with hopefully some of the trade policy uncertainty starting to fade, both as we move further away from the early outburst of trade tensions in the spring last year, and as we move, as I said, hopefully through NAFTA renegotiations and some of that uncertainty starts to ease. Equally, I think inflation is probably going to cool in Canada this year. So, a more material return, particularly in those core inflation measures towards 2%, seems most likely to me as well. So I think they feel in a good place. Absolutely all bets are off should there be a major trade spat with the US. That would be something that we'd constitute probably as more of a demand shock than a supply shock. So, I think that's something that would require probably, again, a further reduction in interest rates. But, it's not our base case. I think that's something that we'd see as a tail risk in 2026.
I have to leave it there. Hey, James, thanks for joining me today.
Okay, fantastic.
Happy New Year. Take care.
Happy New Year. Thank you.
That was James McCann, senior economist at Edward Jones. My name is Mike Eppel. You've been listening to In This Economy. If you've got any feedback on this or any other episode, you can email me directly. My email address is mike.eppel, that's EPPEL, @rci.rogers.com. On social, I'm at Epman, EPPMAN. Again, thanks for listening. We'll talk again soon.